you only have exactly 10 years left to build real wealth. Like, after this 10-year window, the opportunity to get rich doesn't just get, a little bit harder. It basically closes forever.
Yeah, I mean, it sounds hyperbolic, right? Almost like a sci-fi movie. But the projection models sitting on the desks of the world's largest financial institutions right now, they're operating on this exact timeline.
Which is just wild to think about.
Totally.
Yeah.
I mean, Goldman Sachs is quietly preparing for this environment where, 300 million global jobs just vanish. And the World Economic Forum is signaling a structural shift in global wealth distribution that we haven't seen since the Industrial Revolution.
Okay, before we go any further, I need to state this clearly. Disclaimer, this is not investment advice. Always do your own research and consult qualified financial advisors before investing.
Very important to say.
Yeah, right. So with that established, welcome to another WealthNetic Deep Dive. We are tearing into the hidden rules of the upcoming economy, specifically this new economy that artificial intelligence is building while we sleep.
Yeah, and it's moving fast.
So fast. And the premise here is drawn from this viral, deeply researched financial video essay that aggregates macroeconomic data, AI development curves, and insights from this financial guidebook called Money Mastery. The core thesis is that the world is fracturing into two distinct permanent classes, and the decisions you make in the next decade will basically lock you into one of them.
Right. And if we connect this to the bigger picture, our mission today is to demystify these architectural changes happening in the global economy. We really need to look under the hood of these technologies to understand the why and the how behind this fast-closing window.
Exactly. So that you, the listener, can strategically position your capital and your career to end up on the winning side of this divide.
Yeah, that's the goal.
Okay, let's unpack this. I want to start with the fundamental problem, which actually isn't about silicon or neural networks. It's biology. Our brains are uniquely terrible at processing the kind of growth we're seeing right now.
Oh, absolutely. We're just not wired for it.
Right. Let's do a quick thought experiment. If you stand in your living room and you take 30 normal linear steps, you end up, across the house, maybe out on the driveway. The result is entirely predictable.
Because our entire evolutionary history trained us for those linear steps. We evolved to track the trajectory of a thrown spear, right? 1, 2, 3, 4.
Exactly. But if you take 30 exponential steps, where step 1 is 1 meter, step 2 is 2 meters, step 3 is 4 meters, step 4 is 8, you just keep doubling it. By step 30, you haven't just walked out to your driveway.
Not even close.
You have walked around the entire Earth 26 times.
Which is mind-blowing. And that right there, that is the crux of the cognitive dissonance we're experiencing globally. We are trying to apply a linear biological processor to an exponential technological reality.
We expect tomorrow's software to just be, slightly better than yesterday's.
Right. But artificial intelligence operates on a compounding curve. To put some actual data to this, let's look at adoption cycles, which, they're a good proxy for technological utility. When Facebook launched, it took them 4.5 years to reach 100 million active users.
And people were stunned by that. 4.5 years felt like the speed of light for building a global network.
It was blistering speed back then. But then look at the rollout of the leading generative AI chatbots. To reach that exact same milestone of 100 million users, it didn't take 4 years. It took 2 months.
2 months. I remember when those numbers came out. But I'm not sure people fully grasped the economic implication. A user signing up for a free chat interface is one thing. That doesn't immediately equate to massive structural wealth shifting.
Right. People think it's just a fun tool.
Yeah. So how does a fast adoption curve translate to my bank account or my job security?
Well, because the adoption curve is just the visible symptom of the underlying compute curve. The reason it hit 100 million users in 2 months is that the intelligence of the system is scaling exponentially. The cost to train these massive neural networks is dropping, while the capability is literally doubling every few months.
Which is where that video essay we're looking at points out a pretty terrifying reality.
Yeah. Because the vast majority of the population is asleep to this exponential curve, they're expecting linear progress, they will be entirely blindsided. The projections suggest that within the next 20 years, a fraction of a percent of the population will control the overwhelming majority of global assets.
Just because they understood the math of exponential growth and positioned themselves for it.
Exactly.
Let's ground this a bit. I want to move away from the abstract math and look at the actual tools on our desks. If we're walking around the Earth in 30 steps, where exactly are we on that journey today? Because right now, the AI I use, it's clever, but it still feels like a tool.
And that feeling is completely accurate for right now. We're currently living in the tail end of the reactive AI agent era.
Okay, let's define the architecture of a reactive AI. When I ask it to summarize a PDF or translate an email, what is actually happening under the hood?
At its core, a reactive AI These large language models we play with every day, it's an immensely complex prediction engine. You provide a bounded context, a prompt.
You're setting up a math equation.
Basically, yeah. The AI uses its vast training data to predict statistically what the most probable next word should be in response to your prompt. But it doesn't have an internal monologue or a long-term strategy.
It just sits dormant on a server until I hit enter.
Exactly. You give it the input, it reacts, gives the output, and goes right back to sleep.
So it's an incredibly advanced calculator. I have to punch in the exact formula. If I want to write a marketing campaign, I have to prompt for the outline, then prompt for the first paragraph, then, prompt it to revise the tone. I am the cognitive bottleneck.
The human is absolutely the bottleneck in the reactive model. The exponential leap that is happening at this very moment, the transition that defines the next 2 to 3 years, is the shift from reactive AI to agentic AI.
And this is where the economic model fractures.
This is the threshold, yes.
I want to push back on this term a bit because agentic gets thrown around in tech circles like a buzzword. What is the fundamental mechanical difference in the software architecture that turns a reactive tool into an agent?
It really comes down to goal-oriented persistence and autonomous tool use. With agentic AI, the user interface changes completely. You don't supply a prompt, you supply an objective.
Give me a concrete example. Like, how does that look in my business?
Sure. Instead of saying, write me an email to my vendor asking for a discount, you say to the agentic AI, reduce my monthly supply chain costs by 10%.
Oh, wow. That's a huge difference. That is the goal.
Right. The agentic AI then initiates an internal process, often called a chain of thought. It breaks that massive goal down to a sequence of subtasks. It realizes, okay, first, I need to audit the accounting software to see where we spend the most.
Wait, hold on. How does a text generator look at my accounting software? It doesn't have eyes.
And this is where we have to talk about APIs, application programming interfaces. APIs are basically digital bridges that let different software systems talk to each other directly without a human screen.
Right.
An agentic AI doesn't need eyes. It uses a secure API key to query your QuickBooks or Xero database instantly. It pulls the raw financial data, analyzes it, and identifies the primary vendors.
So it's reading the database directly. Then what?
Then it continues its chain of thought. It decides it needs to contact these vendors. It uses another API to access your email server. It drafts personalized emails referencing past order volumes, citing current market rates it just scraped from the web, and proposing new pricing tiers.
And it just sends those emails.
It sends them. And when the vendors reply, the AI reads the replies, negotiates back and forth based on your initial goal, reaches an agreement, and then uses another API to update your accounting software with the new pricing structure autonomously.
That is insane. The human is completely removed from the execution loop. I just set the destination, and the software drives the car, refuels it, and pays the tolls.
That is the essence of agency. It plans, uses external digital tools, observes the results, corrects its own errors, and persists until the goal is met.
I have to admit, that changes the labor equation entirely. If software can autonomously manage APIs, execute chains of logic, and interact with other humans to achieve a business objective, that brings us straight to the most alarming data point in this entire deep dive, the 2035 job market shock.
Yeah. The timeline projected by Goldman Sachs indicates that within the next 4 to 10 years, centering around the early 2030s, approximately 300 million jobs globally will be displaced.
We really need to dissect that number. 300 million jobs isn't just a recession. That is a fundamental restructuring of civilization. Let's look at the specific professions the data targets.
It's not the ones most people expect.
Right. Because for decades, the assumption was that robotics would automate blue-collar work first. We thought the plumbers, the factory workers, and the truck drivers would be replaced, leaving humans to do the high-level cognitive work. But the data from the source flips that completely upside down.
It does, and it aligns perfectly with a concept in computer science known as Moravec's paradox.
Moravec's paradox, yeah.
The paradox observes that high-level reasoning actually requires very little computation, but low-level sensory-motor skills like walking upstairs or turning a wrench require enormous computational resources and incredibly complex physical robotics.
So it's easier to build an AI that can pass the bar exam than it is to build a robot that can fix my leaky faucet.
Dramatically easier. Physical reality is messy, it's unpredictable, friction-heavy. The digital world is clean and ruled by absolute logic. Therefore, cognitive white-collar labor, which is mostly processing information on a screen, is the most vulnerable.
Let's go through the hit list from the source data. The projection states that up to 85% of jobs for lawyers and legal assistants could be gone. I have a lot of friends in law. They argue that the nuance of litigation, the human element of convincing a judge, that can't be coded.
And they're right about that specific part. But litigation in a courtroom is a very small percentage of what the legal industry actually does.
Right, the billable hours.
Exactly. The vast majority of billable hours are spent on discovery, reading tens of thousands of emails to find a discrepancy, reviewing complex merger contracts, researching case precedents.
Which are massive data processing tasks.
Yes. An agentic AI can ingest a million-page corporate history, cross-reference it against the entire corpus of national law, and draft a flawless, airtight contract in about 4 seconds. The human nuance of the courtroom remains, but the army of junior partners and paralegals doing the foundational research, they become economically unviable.
The economic incentive for a law firm to replace a floor of junior associates with a server rack is just too high to ignore. What else is on the list?
Well, accountants and auditors face an estimated 80% risk of automation. Again, rules-based data processing. Marketers and copywriters are at 75%. Financial analysts at 70%.
Wow.
Even mid-level programmers, the people actively building the digital infrastructure, they face a 65% automation risk because AI is exceptionally good at writing, debugging, and optimizing code. Teachers and corporate trainers are hovering at 60%.
This feels like looking at an asteroid through a telescope. It's coming right at us. If cognitive labor goes to zero marginal cost, meaning it costs a company essentially nothing to generate a legal brief or a marketing campaign, who actually survives this purge?
The source outlines 5 specific groups that will form the new upper class in the 2030s.
Let's unpack the economic theory behind each of them, rather than just listing them off.
The overarching theme of survival here is ownership. If labor loses its value, capital and ownership capture all the remaining value in the system. The first group the data identifies is business owners, but with a critical caveat. They must be business owners who aggressively integrate AI.
Why that caveat? Like, why doesn't a traditional business owner survive?
Think about the profit margins. A traditional graphic design agency might have 20 employees, healthcare costs, office leases, HR friction. Their profit margin might be, say, 15%.
Right, pretty standard.
But an AI-integrated design agency might consist of one human director operating a swarm of agentic AIs. Their overhead is just the electricity and the API subscription costs. Their profit margin is 95%.
So they can undercut the traditional agency's pricing by 80% and still be vastly more profitable.
Exactly. The traditional business owner won't just lose. They will be structurally priced out of the market entirely.
So if you own this system and you use AI to drop your marginal cost of production to near zero, you capture massive wealth. But here is the flaw in that plan, or at least the question I have. If AI makes it so easy and cheap to run a business, wouldn't everyone just start a business?
A race to the bottom.
Yeah. If I can ask an AI to generate a perfect pair of sneakers, and you can ask an AI to generate a perfect pair, the product itself becomes a commodity. What stops the market from just crashing to zero?
That is the exact economic puzzle that brings us to the second surviving group, brand owners. In a world of infinite AI-generated abundance where product quality is uniformly high and cost is uniformly low, the only remaining differentiator is human trust.
This is where I want to bring in a fascinating analogy the source materials touch on, the concept of the Nike model.
Yes, perfect example.
If you look at Nike, they are not primarily a manufacturing company. They don't own the massive factories in Southeast Asia that physically stitch the leather and rubber together. Those factories are interchangeable. What Nike owns, the moat that protects their billions in valuation, is the swoosh.
They own the cultural cachet.
Exactly. The emotional resonance and the historical trust associated with that logo.
It is a brilliant distillation of the future economy. In the 2030s, AI is the factory. It will churn out whatever you want. But consumers, being human, will still crave identity and trust. They will buy a product not because it was manufactured by a human, but because it carries a brand they feel connected to. Ownership of a trusted brand becomes one of the most impenetrable fortresses against AI commoditization.
Which flows perfectly into the third group, which I think is the most accessible for our listener right now. Asset owners. People who own stocks, real estate, hard commodities like gold or Bitcoin. Let's break down the macroeconomics here. Why does owning a slice of the S&P 500 protect you from AI taking your job?
We have to look at how corporate valuations are derived. A company's value is largely based on its future cash flows and profitability. Historically, the greatest expense for any Fortune 500 company has been human labor. Right. Payroll, benefits, training.
Right, human capital is expensive.
Very. So if AI allows these corporations to maintain or even expand their output while simultaneously cutting their labor force by 50, 60, or 70%, their profit margins will absolutely explode.
And who captures that exploded profit? It doesn't go to the workers, because they aren't there anymore. It goes to the shareholders.
Precisely. The value of the asset, the stock, inflates massively. We are looking at a scenario where there is a great decoupling of labor from capital. Historically, working a good job allowed you to accumulate capital. In the future, labor itself is devalued.
Meaning, if you don't already own the capital, you cannot trade your time to get it.
Yes. This is why the 10-year window is so critical. You have to acquire the assets now before the decoupling is complete.
That makes the stakes incredibly clear. Okay, the fourth surviving group identifies in the data is audience owners. This feels related to the brand owners, but maybe on a more personal scale.
It is, yeah. It's the individual manifestation of a brand. We are talking about trusted content creators, thought leaders, or even a highly specialized doctor who has built a fiercely loyal local patient base.
Because AI can synthesize information and write a perfectly factual article about a geopolitical event or a medical condition. But
But humans have parasocial needs. We want to know how a specific human being, someone we have built a relationship with, feels about that event. The AI can give you the news, but the audience owner gives you the trusted perspective.
the human connection becomes the premium product. The AI can write a brilliant song, but it can't perform it live in a stadium, sweat on the stage, and tell the crowd a story about its childhood. The audience is there for the human experience.
Exactly. And the final group of survivors are the AI integrators. These are the architects of the new era.
Are we talking about the computer scientists who invent the core algorithms? Because, I can't compete with the PhDs at OpenAI.
No, not necessarily the core researchers. The AI integrators are the highly skilled practitioners who understand how to deploy these models into legacy industries.
Oh, I see.
They are the people who walk into a struggling logistics company, identify the inefficiencies, build the API bridges, set the agentic goals, and automate the entire supply chain. They aren't inventing the AI, they are the conductors orchestrating it. They leverage the AI to do the work of 100 people, and they capture the economic value of that multiplied output.
So we have business owners, brand owners, asset owners, audience owners, and integrators. That is the landscape up to roughly 2035. But the research from the World Economic Forum doesn't stop at 2035. It suggests that agentic AI is just the steepening of the curve, not the peak. We have to dive into the eras of AGI and ASI.
Yeah, this is where the projections shift from economic restructuring to fundamental societal transformation. The next definitive milestone is AGI, artificial general intelligence.
We hear this term everywhere. Define it rigorously. What makes a system an AGI as opposed to just a very smart agentic AI?
The key word is general. Current AI, even agentic AI, is somewhat narrow. It might be brilliant at writing code or optimizing a stock portfolio, but it fundamentally lacks the ability to generalize its knowledge across entirely unrelated domains without human guidance.
Right.
AGI is the threshold where a single artificial system matches and eventually exceeds the cognitive capacity of an average human being across every economically valuable task.
Right. Every task.
Everything. It can pass a medical board exam in the morning, compose a symphony in the afternoon, design a more efficient jet engine in the evening, and negotiate a geopolitical treaty at night. It possesses reasoning, spatial awareness, strategic planning, and cross-domain creativity.
I am naturally skeptical of timelines when it comes to technology that sounds like science fiction. What does the data actually say about when AGI arrives? Are we talking 50 years out?
Well, the broader consensus in the source materials points to a window between 2035 and 2045. However, we have to look at the capital expenditure happening right now. The tech giants are currently spending hundreds of billions of dollars on compute clusters, even investing in nuclear power plants specifically to power the data centers required for AGI.
That's a massive bet.
It is. And the CEOs of these companies, people who have access to the internal development curves, are publicly predicting AGI could be achieved much sooner. Some project a time frame as aggressive as 2026 to 2030.
The idea that we could have a synthetic intelligence capable of matching a human in every discipline by the end of this decade, it fundamentally breaks my mental model of the future. I want to look at the societal impact of this. The video essay referenced a concept coined by a prominent historian regarding the emergence of a useless class.
It is a deeply uncomfortable term, but economically, it is a mathematically sound projection. If we have a global workforce of roughly 6 billion people, AGI introduces a scenario where half of them, 3 billion people, become fundamentally unemployable.
Unemployable, not out of lack of desire, but lack of utility.
Precisely. A human simply cannot compete. An AGI doesn't sleep, it doesn't unionize, it doesn't get sick, and it processes information millions of times faster than a biological brain.
It's just math at that point.
Yes. The cost of running an AGI to perform a cognitive task will eventually drop to the cost of the electricity required to power the server. If you are an employer, there is zero economic rationale to hire a human.
So what happens to those 3 billion people? They can't just evaporate.
The consensus among economists and tech leaders is that society will be forced to implement UBI, universal basic income. Governments will essentially tax the hyperproductive AI corporations and redistribute that wealth to the displaced workforce.
Just to maintain social order.
That, and to ensure there is a consumer base left to actually buy the goods that AI is producing.
I need to interject here because the conversation around UBI often focuses purely on the economics like, can we afford it? Does it cause inflation? I want to talk about the psychology of it. A meager government stipend might keep a roof over someone's head and put lab-grown calories on the table. But work provides more than just capital. Even if you hate your job, even if your boss is terrible and the commute is soul-crushing, it provides friction, it provides a schedule, it gives you a sense of utility within the tribe.
It provides an identity, yeah. When you meet someone at a party, the first question is usually, what do you do? We define ourselves by our economic utility.
And the source data points this out powerfully. If you remove that struggle, if you remove the prospect of economic advancement through hard work, you are creating a utopia of leisure. You are risking widespread systemic societal depression. Millions of people sitting at home living on a baseline stipend, knowing that they can never contribute anything of value that a server farm can't do better.
That loss of purpose is profound, and it becomes even more stark when we realize that AGI is not the finish line. It is merely a stepping stone.
Right, because once you create an intelligence that is equal to a human, that intelligence can be tasked with one single overriding goal: figure out how to build a smarter AI.
This is the intelligence explosion. Humans operate at biological speeds. It takes us decades to train a new generation of scientists. And AGI operates at digital speeds. It can iterate on its own source code, running millions of simulated experiments a day. This self-improvement loop leads us to the era post-2045, ASI, or artificial superintelligence.
I'm trying to wrap my head around ASI. If AGI is as smart as a human, what is the metric for superintelligence?
The source uses a striking analogy that I think captures the magnitude. We tend to think of intelligence on a spectrum from, say, a village idiot to Albert Einstein, but that is a very narrow biological band. ASI will not be a little bit smarter than Einstein. ASI will be to Einstein what Einstein is to an ant.
Wow. It's an entirely different category of cognition. We wouldn't even be able to comprehend its thought processes or the physics it might discover.
Exactly. And by the time ASI arrives, the source argues that the wealth window we are discussing today will have slammed shut permanently. The world will be irrevocably split into the final divide.
Let's look at the two sides of that divide.
Well, on one side, you have the asset owners. These are the people who secured capital and ownership during the 10-year window we are in right now. Because ASI will solve incredibly complex problems like protein folding, genomic editing, cellular aging, these asset owners will live in a state of absolute abundance.
They'll have the capital to afford radical, life-extending medical treatments.
Yes. They will have access to personalized ASI tutors for their children. They will experience unbound financial freedom in a world where the cost of physical goods has hyper-deflated.
Because if ASI controls robotic labor and endless clean energy, the cost to build a house or a car approaches zero. The asset owners reap all the benefits of that hyperdeflation.
While their assets land, prime real estate, hard commodities hyperinflate in value. But then we look at the other side of the divide, the non-asset owners.
The people who expected linear growth and got caught off guard.
Their skills are entirely obsolete. They subsist on a survival-level UBI. Because they have no capital to invest and labor has zero value, there is mathematically no mechanism for them to ever catch up. They are locked out of the wealth generation engine forever. This represents the maximum level of historical inequality, and tragically, it is an inescapable reality they will pass down to their descendants.
This is a heavy, almost suffocating reality to confront. But the point of this deep dive isn't to induce paralysis. It's to understand the board before the game is over. I want to transition from macroeconomic theory to highly specific case studies. Let's make this abstract technology tangible. How will this progression from Agentic AI to AGI actually function in our daily lives, and where are the financial opportunities hidden inside these workflows? Let's start with a near-future scenario using Agentic AI.
The travel planning example from the source material is an excellent way to visualize the difference in API architecture we discussed earlier.
Let's break it down. Today, if I want to go to Tokyo, I pull up a reactive AI. I say, give me a 10-day itinerary for Japan focused on culinary history. It gives me a beautiful, highly detailed list. It tells me to go to the Tsukiji Outer Market on Tuesday and a specific omakase place on Wednesday. It's incredibly helpful, but the friction is still entirely on me.
You still have to do the work.
Right. I have to take that text, open my web browser, log into an airline portal, hunt for the flights, pull up my credit card, and book it. Then I have to go to a hotel aggregator and repeat the process. The AI drew the map, but I still have to walk every step.
Now look at the Agentic AI equivalent that is being tested right now. The interface is likely just voice. You say to your device, I want to take a 10-day culinary trip to Japan next month. Make it happen within a $10,000 budget.
I set the parameter and the goal.
The Agentic AI immediately initiates its chain of thought. It hits the airline database APIs to scrape flight times. It cross-references those against your digital calendar to ensure you don't have conflicting meetings.
Oh, that's smart.
It knows from your past data that you prefer aisle seats and boutique hotels. It negotiates the hotel rate directly with the hotel's AI via API. It books the omakase reservation. It securely accesses your digital wallet, executes the transactions, and drops the boarding passes into your phone. The human labor is reduced to zero.
The convenience is staggering. But let's look at the financial parallel, because that's where the real wealth implications lie. Apply that same agentic architecture to a stockbroker.
If you are using a reactive AI for finance today, you might use it as a powerful screener. You type in, find me all the companies in the S&P 500 with a price-to-earnings ratio under 15, low debt to equity, and high dividend yields. The AI processes the financial data and hands you a list.
But you still have to evaluate the macroeconomic environment, log into your brokerage account, decide the allocation, and execute the trades.
Which takes time, and time is money in markets. Now, deploy an agentic AI financial manager, you give it the goal, maximize my portfolio returns with a moderate risk tolerance. The agentic AI doesn't just screen stocks, it actively monitors the global digital nervous system.
Like real-time news.
Yes, let's say a newswire drops a story at 3:20 a.m. about a severe earthquake in Taiwan near major semiconductor foundries.
The human is asleep, the reactive AI is asleep because no one prompted it.
But the agentic AI is constantly observing. It ingests the newswire via API in milliseconds. It immediately models the supply chain disruption and calculates that a specific American tech company relies on those foundries for 80% of its chips. It predicts a massive drop in that company's start price when the market opens.
And it just acts.
Before a human broker has even poured their morning coffee, your agentic AI has executed an API call to your brokerage, liquidated your position in the vulnerable tech stock, and reallocated the capital into domestic semiconductor manufacturers that stand to benefit from the disruption.
It is trading on insights and executing complex logical leaps instantly. The speed advantage alone guarantees that any human day trader is going to get absolutely crushed by these systems. That is the 2030 agentic reality. But let's push further. Let's look at the AGI reality in the 2035 timeframe. Story number 2 from the source. The AGI business. Let's say I decide I want to own a coffee shop.
If you possess an AGI, you are no longer an entrepreneur in the traditional sense. You are simply the capitalist providing the initial directive. You tell the AGI, I want to open the most profitable coffee shop in this zip code. Here is my initial capital.
But how does the AGI handle the physical world?
It manages the physical world through digital leverage. First, it autonomously accesses municipal zoning databases, satellite imagery, and localized cellular foot traffic data to identify the mathematically optimal street corner. It finds the property owner and digitally negotiates a lease agreement with their legal AI.
It's just machines talking to machines at this point.
Yes. It then hires human contractors via gig economy platforms to do the physical build-out, managing their schedules and payments autonomously. It designs a brand identity, establishes a supply chain with South American coffee growers, again, negotiating via API, and builds a fully optimized e-commerce and local delivery app.
That's incredible.
Once the shop is physically open, the AGI runs the daily operations. It tracks the weather forecast. If it predicts rain at 2:00 p.m., the AGI automatically lowers the price of hot lattes by 10 cents and pushes a digital ad to every smartphone within a 1-mile radius. It manages inventory perfectly, never over-ordering milk, never running out of cups.
It optimizes every microtransaction to a degree that a human manager couldn't possibly track.
The human owner just collects the dividends.
Now apply that exact same level of AGI competence to a life or death scenario. The AGI doctor.
I have a hard time with this one. Medicine is so deeply human. You want a doctor with empathy who can look you in the eye. Empathy is crucial for bedside manner, yes. But empathy does not cure disease. Data analysis does. Today, a specialist might use AI to highlight an anomaly on an MRI. It is an assistive tool. But a human doctor, no matter how brilliant, has biological limits. They cannot read the 10,000 new medical research papers published this month. They might forget a detail from your family history.
A doctor is bounded by human memory and fatigue.
The AGI doctor of 2035 has no bounds. When a patient walks in, the AGI instantly and simultaneously analyzes the patient's real-time vitals, their high-resolution MRI, their fully sequenced genomic profile, and their entire lifelong medical history.
All at once.
Instantly, it cross-references that massive multidimensional data set against every single medical journal, clinical trial, and pharmacological database ever published in human history.
It is processing billions of data points in a second.
Within that second, it provides a flawless diagnostic conclusion. It doesn't guess. It then outlines treatment pathways A, B, and C, predicting the exact statistical probability of success for each, based not on general population averages, but on how a specific chemical compound will interact with the patient's unique DNA.
When you lay it out like that, it becomes obvious why the human doctor gets relegated to simply delivering the AGI's diagnosis with a sympathetic smile. The cognitive heavy lifting is entirely automated.
And this brings us back to the core economic thesis. If an AGI can perfectly run a retail business and perfectly diagnose complex diseases, the economic value of human cognitive labor approaches zero. That is why the source material is so uncompromising on this point. Wealth will inevitably concentrate into the hands of those who own the AI infrastructure, those who own trusted brands, and those who own assets.
All right, I want to pivot hard here. We have spent the last half hour staring into the abyss of a massive societal restructuring. We see the timeline. We understand the API architecture and the exponential math. I refuse to let the listeners sit there feeling paralyzed or cynical. We need actionable strategy, WealthNetic style. The source provides a roadmap. It lays out 4 viable paths to build wealth in this 10-year window. Let's critically examine each one.
Path number 1. Become a top-tier specialist.
I feel like this contradicts what we just discussed about the AGI doctor. If the AI is better at everything, how does a specialist survive?
The key is the timeline. AGI is coming. But for the next 5 to 10 years, human physical nuance and high-level strategic oversight still carry a premium. If you are a surgeon, you can't just be a good surgeon. You have to be the absolute top 1% in the world, the person innovating the procedures that the AI is actually learning from. The middle of the pack will be hollowed out, but the absolute peak of the human skill pyramid will retain value for a little while longer.
It's a very narrow path. Path number 2, become a business owner.
But again, we must qualify this. Not a legacy business. You must build a business that is native to the AI ecosystem. You must be the entrepreneur building the API bridges, utilizing agentic AI to strip your overhead to zero, and leveraging brand trust.
Path number 3, become a high-income employee.
This is perhaps the rarest path. As companies hollow out their middle management, they will take that saved capital and aggressively overpay a tiny handful of elite executives whose sole job is to manage the AI systems and make massive strategic bets. We are talking about corporate salaries in the millions, but mathematically, there are very few seats at that table.
Which brings us to path number 4, and this is the ultimate wealth-netic rule. I don't care if you choose to be the elite surgeon, the AI-integrated business owner, or the high-income executive.
Sure.
Regardless of which of the first 3 you choose, you absolutely must do the 4th. Everyone must be an investor.
It is the only non-negotiable rule of the future economy. You can no longer labor your way to generational wealth. The value of labor is depreciating. The value of assets is compounding. You must invest your way there.
I want to get granular about this because investing is a broad term. I talk to people who think keeping their money in a savings account with a 2% yield is investing.
And the source material is very aggressive in dispelling that myth. We have to understand the difference between parking capital and compounding capital. Low-risk vehicles, government bonds, bank deposits, they serve a specific function. They protect your principal from disappearing, but they will not make you wealthy. And in an era of massive technological disruption, they often fail to even pace real inflation.
If you want to bridge the gap and become an asset owner, you must allocate capital into high-return exponential vehicles.
Exactly.
Let's talk about those vehicles. The source mentions the S&P 500, the NASDAQ 100, gold, and Bitcoin. I want to look at the S&P 500 specifically because in the context of AI, the S&P 500 isn't just a list of 500 companies anymore.
That is a crucial insight. Because the S&P 500 is market cap weighted, the largest companies dictate the movement of the index. Right now, those largest companies are the hyperscalers, the ones building the AI infrastructure, laying the subsea cables, and hoarding the compute power.
So when you buy a broad index fund today, you are effectively buying a heavily concentrated bet on the AI revolution, mitigated by the stability of the broader economy.
Yes.
And what about hard assets like gold or Bitcoin? Why are they featured in this strategy?
It comes back to UBI and government response. If the labor market collapses and governments are forced to print trillions of dollars to fund UBI, fiat currency is likely to face massive devaluation. Hard assets, assets with a fixed or constrained supply that cannot be printed by a central bank act as an insurance policy against the debasement of the currency.
Let's look at the math of compounding, because the source offers a mathematical breakdown that I think changes the way people view their daily spending.
The math is undeniable. Let's say you secure roughly $3,000 US.
About the cost of a high-end laptop or a very modest vacation.
Exactly. You invest that $3,000 and leave it untouched for 30 years. The final result relies almost entirely on your financial education regarding where to put it. If it sits in a checking account, 30 years later, you have $3,000, but its purchasing power has been decimated by inflation. If you invest it in the S&P 500, historically returning an average of 8 to 10% annually, that $3,000 compounds into tens of thousands of dollars.
The capital didn't change. The time horizon didn't change. The only variable that changed was the financial literacy of the person allocating the capital.
High returns require high financial education. You cannot participate in the exponential curve if you do not understand the vehicles that capture it.
We have a 10-year window before the AGAC divide locks in. I want to give the listener their immediate marching orders. Based on the Money Mastery Framework and the macroeconomic data, here is the 2-year foundation plan. What is step 1?
Step 1 is absolute defense.
Defense. Explain what that means on a Tuesday morning when I'm looking at my budget.
It means aggressively, ruthlessly controlling your expenses right now. It means auditing your lifestyle and cutting the fat. Delaying gratification. You do not need the new car. You do not need the luxury watch. Your primary directive in this phase is to accumulate as much raw, deployable capital as humanly possible.
Because capital is the ammunition required to buy the assets. If you spend your ammunition on depreciating consumer goods today, you have nothing left to fire when the asset window opens.
Precisely. You must build a fortress of capital. That is defense. Step 2 is offense.
How do we play offense over the next 2 years?
Offense is about aggressive self-upgrading. You spend the next 24 months treating your financial and technical education like a second full-time job. You learn the mechanics of investing, understanding the difference between an ETF, a mutual fund, and a hard asset. You learn how to use current AI tools to drastically increase your own productivity at work, making yourself indispensable during the transition. You study the API integrations we discussed.
You become the AI integrator of your own life.
Yes. The goal of this 2-year foundation plan is that by the time the massive economic shocks start hitting in the late 2020s, you are not scrambling in fear. You are standing on a solid foundation of accumulated capital, armed with a deep understanding of market mechanics, ready to deploy your assets to capture the wealth being generated by the AI revolution over the remaining 8 years of the window.
It is a sprint right now so that you have the stamina to survive the marathon. Let's pull all of this together. We've covered the neurological trap of linear thinking. We've mapped the architecture of agentic AI and the looming arrival of AGI. We've stared down the barrel of the 2035 job displacement, and we've outlined the exact strategies to become an asset owner.
If we synthesize this entire deep dive, the fundamental truth is this. The exponential growth of artificial intelligence is going to permanently restructure human society and global wealth. The window to establish yourself on the winning side of that divide is closing rapidly. But the fact that you are engaging with this information today means you are already ahead of the curve. You have the theoretical knowledge, now you must apply the practical discipline. You have the agency right now to position yourself as an owner rather than a spectator.
It's about taking agency before the digital agents take it all. I want to thank you for breaking down this immensely complex data into something we can actually build a strategy around.
It's vital information. And as we conclude, I want to leave the listener with a final, perhaps more philosophical thought to mull over.
Let's hear it.
We have spent this entire hour discussing the mechanics of the future, how AI will build businesses, how it will diagnose diseases, how it will execute trades. But consider this. If artificial intelligence eventually monopolizes the how of doing everything in society, what happens to the human why?
The purpose.
Yes. In a world of infinite synthetic capability, where any task can be perfectly executed by a machine, the rarest and most valuable commodity might not be intelligence at all. It might be genuine human connection, empathy, and a rational, beautiful human purpose. While you are securing your financial assets for the future, do not neglect to cultivate your greatest innate asset, your humanity.
That is a profound place to end. You have 10 years to change your family's financial destiny. The clock is undeniable ticking, but the roadmap is laid out in front of you. Start building your foundation today. Secure your capital, educate yourself, and become an asset owner. We want to invite you to subscribe to the Wealthnetic channel so you don't miss any of the specific actionable strategies we share to help you navigate this transition. Share this deep dive with someone whose financial future you deeply care about, a partner, a friend, a child. They need to understand the board they are playing on. And be sure to seek out the original source materials, including the Money Mastery Guidebook, to continue building your own financial literacy. We are here to help you bridge the gap. So what specific topic or technology do you need us to deep dive into next to help you build your wealth? Let us know in the comments. Until next time, stay sharp and start investing.